Hey guys, in this video I'm going to walk you through a super simple call credit spread strategy step by step that can help you have a 72% win rate and make a 30% annualized return. That's right, you can 3x the average market return by following this one simple strategy that I'm going to give you step by step. So let's dive in and see how this works. So I'm going to go through the criteria, what to look for, then I'm going to show you on a stock chart so it makes sense. All right, so here we go. Number one, you want the SMA 10-period moving average price to be less than yesterday's value. You want the stock price to be underneath the 10-period moving average. You want the price to be greater than -3 standard deviations of the moving average. And you want the stock price to have moved no more than 1% and no less than -1%. So let's look at this specifically. Hey guys, just want to hop in here real quick and let you know about a free training that I'm doing here very soon. If you click the link down below, you can access it and learn how I make $3,000 to $5,000 every single month using the new Mother credit spread trading strategy. I'm going to walk you through it step by step. So by the end of the training, you'll walk through knowing how to actually implement it and use it for yourself. So you can risk $25 to make $25 with a 75% win rate. So if that is interesting to you, please make sure to click the link down below and save your spot. All right, enjoy the rest of this video. Here, number one, what do we want to happen? Well, as listed here, we want the SMA price to be less than yesterday's. What does this mean? It means we want the short-term trend to be going down, right? We want to see that this little band here that we have, the blue one, is pointing down. That means that yesterday's blue line value is less, or should say greater than today. So today's is less than yesterday's, which means it's going down. And so if it's going down, then we have a short-term trend which we can capitalize on for call credit spreads. Next, we want the stock price to be under the 10-period moving average. So this blue middle line right here is the 10-period moving average, and we're below it. So that's check on that criteria. Next, we want the stock price to be greater than -3 standard deviations of 2-period moving average. Sorry, I can't talk sometimes. Anyways, so we discussed last time in the put credit spread strategy, there's a recovery approach where the stock goes below this bottom yellow line, then it's highly likely mathematically to bounce and make money for you if you're trading to the upside. You see here, bounce, 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 right? And so because of that, we trade a put credit spread approach in that scenario. So we don't want the stock to be below this yellow band, because when it is, then now we know that the market is most likely going to recover. So we want to stay out of the market. We want to be in call credit spreads when the market is headed down. So we can do the call trading approach when it's above this bottom yellow line. Now, if you're wondering where this indicator comes from, you have it for free as a part of this course. So again, you can access it linked above or down below to get this for yourself. Okay, number three, no, that was number three. Number four, so if we're looking at the daily price movement, which you can see for today, if we look up here in this corner, this little parentheses thing, it shows the daily price movement for today as -0.04%. We want to make sure that the movement of today is greater than -1% and less than 1%, so within a 1% range. Why? Well, because that just historically works best. You don't want to really enter on strong up days or strong down days, because then that means the trend's either changing or over. But instead, we're just going to get in safely in these type of positions. So that's what we're looking for in those setups. Next is the expiration date. What do we choose? It's the same for the put credit spread strategy, where it's the current day +9, and we round up to Monday, Wednesday, or Friday if +9 ends us up on a Tuesday or Thursday. So for instance, when I record this video, that's October 5th. So if we add 9 days, it makes it October 14th. And I believe that's a Wednesday, so we would stay there. So October 14th would be our expiration date. Next, our strike price would be roughly 1% above the stock price. That would be our call credit trade. But for this one, we're going to be using a 25 delta, and we're going to be placing a $1 wide call credit spread trade based on this setup. Now, if we follow that to a T, then we'll have a 72% win rate with a 30% annualized return. This is historically since 2014 what the returns we could have expected, and it's working for us right now. This is the exact strategy that we're using in the market right now to make money. This strategy strategy alone on my small account has made me almost $1,000 just by trading this downside portion right here. So this is a great call credit spread trading strategy when the market is recovering. I mean, when the market is heading down to the downside because we pushed up too fast and now we're starting to retrace. This is what that strategy is good for. Anyways, guys, you can implement this right now, or you can have the algo do it for you where it looks for this criteria step by step already, does all the math, all the calculations, all the chart reading. You just need to look for, okay, this is the strategy, the alert for today based on this setup. Just place it, and now you're good to go. You'll have a 72% win rate, a 32% annualized return, and you can place the trade in seconds. All right, guys, I hope that makes sense. I'll see you in the next lesson.